So with being so specific, I'll be able to put on a lot more size, a high probability place to accumulate the response from ChatGPT. Start using it as a trading coach, but at the same time, I'm letting my family down.
Until you're specific enough.
That midpoint is where you go short. So there's our first TP to how my day went yesterday. The more of a premium I can charge for it, minimum first take profit. I've been saying it for years, like ever since I started trading, but I'm this close. This is going to be a review for Monday, the 24th of November. Didn't go quite how I wanted. This is actually a daily loss limit for Tuesday, believe it or not, which is already Tuesday started 44 minutes ago. I just forgot to change the max daily loss limit away from $400, which I just temporarily set. That was Friday actually, so I didn't actually trade NASDAQ at all. Just trading gold, and you can see what went wrong this morning. Took an initial loss on this drop down into the range. Got in again once we got this confirmation and a retracement below this 15-minute candle. It's just hit the max daily loss limit without stopping me out. I did take it on a demo account though. You can see I've got my first take profit set up here. And this is me practicing my new profit taking framework. So over the weekend, as I said I would, I spent a lot of time just collaborating with ChatGPT to work out a profit-taking framework that was very objective and helped me maximize my trades. This counts as an alpha, and the two variants are we've got the alpha and delta. Alpha is when both the high time frame drawn liquidity and the hourly trend direction are in the same, going the same way as my trade. In this case, we were clearly drawn towards the previous week high. Although I was bearish yesterday, we did end up going towards the previous week high, so the draw was higher. The hourly trend, as you can see, is very clearly bullish. And there's a 15-minute fair value gap just above us that I believe we're reaching for. I'll be taking another 25 off up here. So it's I should be managing this trade, I suppose. But once we're beyond EQ and clearly in expansion and we've hit ERL, that's when I start using the 2-minute trailing stop. So at the moment, I'll be using a 2-minute trailing stop, which simply means identifying the previous 2-minute candle, which should be all the way down here. And then every time we break a new 2-minute candle's high, I'll be trailing the stop up following that, and that gives it the chance to really make that movement. There is my drawn liquidity, like where I think we're reaching for, is actually what we've just hit right here, a 15-minute fair value gap. Really nice impulse high above us as well, but we have just hit that point of interest I had, so it would make sense to take a partial up here as well. I suppose I might as well just take something off. But yeah, essentially you just want to trail using that 2-minute trailing stop. Now, the things that did wrong yesterday were that I was short biased and I actually caught a few incredible shorts. However, I did not hold them how I should have. As you can see, I just executed a alpha execution, which is giving the trade chance to move in my direction because it's likely to have a more extended move. Over this side, we have the same scenario. I believe that price was heading lower, so the drawn liquidity was lower. The trend direction after this breakdown on Friday was also heading lower. So in this area right here, when I was going for those shorts, I should have executed in the same way, taking that first partial at a deep discount of the range or below an hourly low. The shorts that I took, I got short right here on a impulse rejection failure of this low. So I got short just there, really tight stop. And I should have been targeting at a minimum deep discount and turn range, which should have been this short-term low down here, or the hourly swing low, which would be all the way down there. So for the first take profit, it should have been down at this area. However, I ended up taking it off basically right there for just a fairly small win. Very tight stop, but still, Yeah, should have been leaving it a little bit further. We then rally back into the range. I see us get this failure swing. I was kind of anticipating more than trading what I saw, but I anticipated a failure swing and also anticipated 1900 to fail to take out the previous hourly candle high, which would have made it a squeeze reversal, which means that this is a very high probability target. And that's exactly what happens. 1900 opens up, wicks high on 15 seconds. It showed some very nice signs of reversing. I jumped in short and then started just second guessing it. And as it sold off, although it started accelerating in my direction, I just took it off and didn't give it a chance to work. We then later on continue pushing lower. I did catch a small short in this area down into this range and also caught the breakout short here. But the key thing is that if I had traded using the alpha protocol, the alpha take profit protocol, that would have meant that the first take profit, if I'd gotten here, would have been this swing low, a deep discount and turn range, or external down here. That would have been the absolute minimum first take profit. Then the same thing with getting in of a short here. We have that deep discount and turn range over here, since we're within this higher time frame dealing range at this point. And within this range, we're now inside of it. So that becomes our deep discount and turn range liquidity. Previous hourly candle low as well. So that would also be a valid partial opportunity. And then just trailing using a 2-minute trailing stop, which I'm not even sure if it would have got stopped out. It might have. But if we jump onto the 2-minute charts and zoom in, you can now identify that that would have stayed in, would have continued holding this trade. The stop would have been above this candle's high until we break the low there. We then break the low once again here, so stop would have been trailed down to this high, and that doesn't even get hit actually. So it actually did not hit that stop. Then once we break this low, we would have begun continuing to trail, eventually getting stopped out. Not even here. Like at this point, that's the previous 2-minute candle high. We break that candle's low, meaning that the stop loss goes here. We never took out this candle's low, consolidate within this range, so we never actually trailed down to this high. So stop loss would have been up here, rallies, sells off down to the range, and eventually makes a low and reverses. So that's a very effective way to trail stop when you were in an expensive move, and that's one of the protocols. And I'll show you the protocol real quick because this is just a double up of the exact same thing. What I might do is I might open up ChatGPT and go on to that particular page. So I did a whole brainstorming session and built up a really nice protocol to follow. And this, I came up with a beautiful framework, beautiful model of exactly how I should build it out. And that's what I've been doing over here. So on this page on the left, it's my Notion page. These are the 2 of the 3 frameworks I want to trade, that I want to focus on and be a specialist service provider within these frameworks. So rather than trading my, I think, 100 different things that I look at in the market, just focus on 2 and then be very specific with the what qualifies as an order. So order qualification, I should make this a bit bigger. Order qualification, service delivery protocol. So exactly how do I execute? So what qualifies as a setup? How do I execute that setup? Like where do I enter and where do I place the stop? Then the invoicing protocol is just a fancy way of saying how I'm going to take profits, but in a very specific manner. And as I mentioned in a previous video, just like 2 videos ago, I came up with a observation that when you have both the high time frame drawn liquidity, so the destination price is going to on the high time frame, when that is in one direction, and then your mid time frame trend direction agrees with that direction, that's when you're going to have the most expansive moves. And you want to really give your trades a chance to move in your direction. Whereas when one of those are off, either the high time frame draw or the mid time frame trends are not in agreement with each other, or your trade, then you want to be going for base hits, and that's why we've got these delta and alpha. Delta actually means what did it mean? I think it means like to diverge. Yeah, it means to diverge, like a mouth of a river diverging. So when they're going the wrong way, different ways, that's why it fits so well. Then the delta trade is going to be a base hit. So that's why it's called the base hit protocol. And the definition is the type delta is against high time frame draw or against intermediate trend. Delta equals a trade that must pay you at the first logical reversal point. If it wants to give more, you let it, but only under supervision. No giving back, no dragouts, no hope. Clip it, protect it, and move on. So this becomes the standard protocol for the delta trade type. And then when you then jump to the specific frameworks, such as sell the dip, etc., you then add specific nuances for your take profit protocol. I'll give a brief example of that. But for delta, it's very straightforward. It's just base hits essentially. So it's not too specific. And I'll read through this in a bit, but you can see I've got the minimum profit baseline, so the first take profit, a hard invalidity condition, a mandatory BE move milestone. So once we do a certain action, you're going to break even no matter what, because being delta, it has a high chance of reversing against you. And so you just want to lock it in. And then the exit philosophy. So just no runners, just taking that base hit essentially. So now we can trail the stock a bit further, see if we would have got stopped out. So 2 minutes candle, trades back. It doesn't take out that 2 minute candle's low, which is where the stop would have been. So it would have come very close, but not taking it out. Then trades higher, breaks that candle's high. So now the trailed stop gets trailed to something I'm not super clear about, but I believe I would actually trail it up to the internal range low. So yeah, because as soon as we break that high, now we're looking for the previous 2 minute candle's low, which becomes this candle. The whole point of the 2 minute trailing stop is just an arbitrary way to trail the stop in a very objective manner that allows me to catch the high time frame, or like a basically a spooling of price, where price is going to move very aggressively in one direction. It shouldn't retrace much. That's the idea. And you'll find that when price is moving very fast in one direction, it usually won't take out the previous 2 minute candle's low unless it's reversing. So at the moment, we've got the stop below this swing low here, or that candle's low. As soon as we break this high, we then read back to the previous 2 minute candle low, which would be that one. And we can trail the stop to there. At this point, it's really stalling quite a bit. So it might not be quite what we're after, but already, even though like it looks like it might stall in reverse, this is still a decent trade. So if I put a risk reward tool on this, entry was here, our stop, it's just prior to the low, based on this volume imbalance. So what I really liked about this trade was how we've got the previous week high sitting here. We've consolidated against resistance going into the close on Monday, it's just yesterday. And then we had a blast out right at like 16.44, so just before the market closed, a big breakout above that previous week high. So any traders looking to buy above the previous week high, all tripped in long, likely their stops are going to reside down below all these perfectly smooth trendline lows. And below that, there's a volume imbalance. Now, the market will engineer liquidity above inefficiencies such as a volume imbalance for the purpose of there being liquidity, so they can invite buying and selling at those levels. Because there was no, the market moved so fast here, it didn't not many transactions, if any, transactions occurred at this particular range. The market wants transactions there, so engineer liquidity first, drop down into it, makes it a very high probability place to accumulate. So now you can see we can trail our stop to that previous 2-minute candle low. But yeah, that made it quite high probability to reverse from there. I bought on the way down into it, initially got stopped out. I tried buying way too early, essentially. We then got a 15-minute last second wick, and then pull back into the range. You can see that we can't, but this 15-minute wick had no, this 15-minute candle had no wick initially. And so when we dropped down into that, I bought, trusting that this long wick would stay intact because it formed in the last moments of this candle. So it becomes a last second wick. There's our stop out, if it fills it. Then following that, it just works its way higher. But yeah, essentially a lot of liquidity below all these lows after this false breakout above the previous week high. New hourly candle aggressively dropping low. A lot of the time, the new hourly candle will take out a 2-minute candle low, whether or not it continues. But it's a very effective way to trade. And if I can recognize an alpha protocol condition, which is where both the trend and draw align. In the past, a lot of the time I would, let's say I got in here, then price is a little move in my direction. I'm like, oh, you know what? We hit the hourly open, so I better take something off here. Or, oh, there was a big spike. Oh, actually, it's looking a bit more dodgy now. I'm going to get out. Or we'd hit this deep premium high, and I'd figure, well, I might as well just take it all off here instead of getting a chance to really run. So what I want to do with this this thing is, if I open up the alpha, I want to be able to identify these conditions and price and have a very robotic way of executing it that allows me to really maximize the trade. So I have, for the alpha protocol, the expansion protocol. I'll read this out real quick. Type alpha is the high time frame draw is aligned with the intermediate trends. Optimal condition for expansive moves, highest expectancy, lowest friction. This is the standard protocol for the alpha trades, and specific framework nuances layer on top of this. So this is like the baseline, just like your go-to. And then if there's something specific, such as in a sell the dip type scenario, you're looking for the first partial to be at the premium end, or sorry, the discount end of the fair value gap that you're trading down into. And then the second one would be the impulse low that you're targeting, which are in these particular pages down here. But for the basic one, we just have the minimum first take profits, event-based milestone before stop management, and then trailing logic once the market proves itself. And that's using prior to EQ. So prior to getting into if you're long, like in my scenario just then, prior to getting into a premium of the range, we're in a discount. And so you're using a 5-minute order block for your stop loss. As soon as we get past EQ plus price is spooling, which means it's clearly moving intentionally in one direction, so not high resistance, then you employ the 2-minute trailing stop. And then we've got a kill switch condition that invalidates the alpha protocol. And that's when we hit let's say an hourly high or low, get a really strong rejection, and the 1 hour / 15 fails to close through that high or low and displaces against position. And then run an allocation. If you have a high time frame targets, that's you are pretty, if price is moving towards your high time frame targets and you're in an alpha condition, then it makes sense to hold a bit of a runner. With a minimum target being the high time frame 4-hour swing point or higher. So I'll quickly jump over to my stats on TopStep. This is going to be insightful as to how my day went yesterday. And if you look at my equity curve throughout the day, you can see that I had a really good day, got up to 800 plus in profits. And then eventually I started losing, got all the way back to break even. and then you'll see this big gap. Then eventually at 9:36 a.m. take a $400 loss. That was actually 3:30 a.m. New Zealand time. Because I'm now actually awake during the daytime in New Zealand and asleep at night. This was essentially really late at night. I woke up, thought I'd check what the charts were doing. Nasdaq had hit my take profit without me, and so I cancelled that limit order. And then sort of looked at gold, and gold was in an area where I thought, oh, it could go down from here. And yeah, just jumped in, a bit more size than I'd expected, and took a loss straight away. So taking a $800 day to a negative $400 day, so 1,200 swing. You'll see that this account is actually already, pretty nicely in profit. Well, it was. So this is additional to the $400 I lost this morning. So if we do 1,600 more than this price right here, like we're getting really close to passing the account. It's a bit of a bummer to give back so much in one day. But what I found interesting about this equity curve is that this essentially reflects the goals chart. As I don't know if I mentioned, I did a voice recording earlier as like a review of my trading. So I'm not sure if I mentioned exactly what I did, but essentially I was going short all through this range, going short, caught a nice short right there. Then eventually at around midnight, so just before midnight, I continued trying to short, and I was short all the way up through this range. I took a loss here. I held through like an hour and a half of I held a short, knowing that it was very, very likely going to this high and up here. I continued to hold, which was stupid, and then got taken out, tried again up here, and gave it all back. But what's interesting is that this equity curve reflects this chart. So I was selling as it went down and then selling on the way up. And you'll see that the low comes in at just after midnight. I was selling as we went down, so green, 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 and then around midnight, it suddenly reverses and I start losing. And then I continued shorting, and as you can see, that resulted in more and more losses. Then I took that loss overnight as well, but a bit frustrating. And then obviously today is that. But yeah, kind of a frustrating equity curve. And the thing is that if I'm up $800 on the day on an account that only needed maybe another 300 or 400 to pass the entire account, I'm up huge on the day. We are at a deep discount, the absolute low of day. Why would I continue trying to short? Like, why wouldn't I just leave and just leave it like that? I even sacrificed some very, very valuable, what would have been very valuable family time, going to dinner with my family and my grandparents, to sit on the chart and lose all of this money, give it all back in this challenge account, and also on my personal account, I also gave it all back at the same rate. And I sacrificed a valuable night with my family to do that, which felt really, really bad. And that's kind of, yeah, it made me not have a very nice evening. And I was extremely frustrated at myself, to say the least. But that's how yesterday went. Then I already mentioned today what happened there. But what I want to do now is actually read through the conversation I had with ChatGPT and the game plan we came up with. So initially, I was looking just to come up with a good name to differentiate between the with the trend and with the draw, and when they're not agreeing with each other. Came up with type alpha and type delta. And I want to read through what I said, and then the response from ChatGPT. And this is going to be an example as to how powerful using AI to for your trading is actually going to be. And I really highly recommend that you start using it as a trading coach, help you code things, but most importantly, just if you have any concepts or things you need to get your head around, or maybe you've got a issue like maybe you're over trading or you're taking profits too early or anything like that, you can just basically get it to coach you on it, and it can do an incredible job. But I'll read through this. We had just confirmed the name, and the conversation goes on from there. So what I said was, okay, I'm going to build them, but obviously I need to be heavily involved in this because they are fairly specific frameworks I'm applying this to. Or do I need protocols for each alpha and delta first? I was thinking that delta would be essentially a focus on a base hit that would define a minimum exit so that I'm not just cutting low grade trades at point 2R all the time like I used to. Then for alpha, there would be specific protocols for each different framework. For example, there might be a minimum first take profit and then a certain sequence of events before managing the stop. I have a few ideas already, but I have only observation to back it. No hard data. I'm aware that by getting myself the hard data on various trade management protocols, I will then be best able to execute in a way that maximizes expected value and have confidence that prevents any fear-based exiting. ChatGPT says, here's the clean way to structure this without locking yourself into randomness and without building 20 micro protocols prematurely. You're on the right track. You need a general protocol for alpha and delta first. Then each framework, your specific setups, get its own refinement layer on top. Think of it like a base model that's universal, and then framework specific filters that are custom. This keeps everything coherent and measurable. Let me outline the architecture you actually need so you don't tie yourself in knots. So I really liked how it kind of picked up through the way that I typed this out that I was kind of unsure about it, and I had a few ideas, but I wasn't sure if that was too much or too little. And I found that's a very effective way to communicate with the AI. Is when you know exactly what you want, you can write it in a very specific, direct way that's professionally written, let's say. And the more unsure or uncertain I am about something, the more I'll kind of make my typing a bit more sloppy in a way. And the AI picks up on that, and then it can help it understand how specific of an answer it needs to give me and how much explaining it needs to do. So if I'm really confused in something, like if I'm doing some tax stuff and it's maybe doesn't quite make sense to me and I'm trying to work something out, then I can write it in a very very loose way, like use words such as or like something or very non-specific words. It kind of seems like lazy texting, let's say. But the AI can pick up on that, and it's um what's the word? It basically creates the answer in a way that will help straighten out all those uncertainties. So to talk through the baseline universal model, starting with the delta, I actually call them protocols, but delta base hit protocol. This is the simplest to define because your intention is already clean. Delta behavior equals take the base hit, avoid death by 0.2R micromanagement. What delta needs? A minimum profit threshold to avoid your past mistake, a hard invalidity condition to cut losers early, a single partial rule, if any, mandatory break-even move at logical milestone, no deep distribution. You don't milk delta trades, you skim them. Delta should feel like you hit the ball cleanly, secure the base, and you don't get fancy. This gives you consistency and avoids emotional exits. Alpha, full protocol, well, expansion protocol, essentially. Alpha needs structure because these are the trades where you want to maximize EV, you want to let them express themselves, and they justify deeper management. But alpha should not get over specific at the beginning. You need one general alpha protocol, Then your frameworks plug their own specifics into it. General alpha protocol might look like minimum first take profit, mandatory distribution, event-based milestone before any stop management, a defined trailing logic only after the market proves itself, a kill switch condition for when the alpha becomes invalid, and an optional final runner with a high time frame target. Then for each framework, you define the specific events, you define what counts as proving itself, you define what the high time frame destination is, and you define how the trailing attaches to structure. This avoids reinventing everything from scratch. Something that GPT coached me through that was really helpful, and you can kind of see it a bit here, is being very specific of how I define things. So how do I define trend? What defines as proving itself? How do you define the high time from destination? And just being very specific about them. That removes the ability to be arbitrary about exactly what you're looking for. But if you're very clear with how you define things, you can know that you're doing the right thing all the time, or what you should have been doing. Data first versus observation first. You do not wait for perfect data. You define version 1.0 protocols that are logical, consistent, testable, and not too granular. Then you iterate based on actual data. You're right that confidence comes from executing a protocol that you've pressure tested, not from the protocol itself. So start with the structured hypothesis, gather real samples, refine, and converge. Here's the sequence I'd tell a professional to follow. Step 1, define 2 general archetypes, delta, beta model, alpha expansion model. Step 2 is build delta 1.0 first. This is simple, you'll get fast reps and you'll immediately feel relief of no 0.2R nonsense. I just love how it picks up on my frustration around that 0.2R and it just uses that kind of language. It's exactly what I'm after. And that's what we've got over here. That's what I built. But that's this thing here. Then step 3 is build alpha 1.0 next. One universal protocol, no framework specific details yet. Step 4, only then create specific alpha adjustments. And this is where your real expertise come in. So you'll see that I've got delta and then we've got alpha. These are both the universal frameworks that apply to everything. And then on top of that, for step 4, create this framework, the specific alpha adjustments. Still working on them, but you can see the work in progress over here where we are beginning to define it. And these are going to have specific things such as targeting hierarchy and how to trail the stop, just things that are specific to that particular framework. What you should do next is you give me your current thoughts for delta, even if it's rough, your current thoughts for alpha, your 3 highest volume frameworks. Then we build delta 1.0, alpha 1.0, then one framework specific alpha refinement as a template. After that, you can replicate the structure for all other frameworks. What I find really helpful with this is it just gives you more structure and you're not offloading everything for the AI to do, because obviously if I just say to the AI, "I'll give me a full 100% complete trading plan that I have to follow and I won't have to do anything else," it'll deliver it to you, but you're not going to get anything out of it because you won't be involved in it. You need to be heavily involved in the process of building it. So I'm doing the work, I'm bouncing ideas back off ChatGPT, I'm asking it questions, and like you can see up here, I I'm just bouncing thoughts off it. I need to be heavily involved in it, or do I need general protocols for each of them first? I was thinking this, I have a few ideas, but I have no observation. Should I do this? Should I do that? The problem is fear-based exiting, and you're kind of giving it all this information. It bounces back a pretty structured game plan to you. You can then use that game plan and bounce ideas back. All these little stars are just the from using italics or bold or one of these boxes. I basically typed in here, then just copy paste. But you can see that I clearly listed out all of the different frameworks and all the different ideas behind it, and gave it a bit of confirmation that it's on the right track. You absolutely nailed the game plan. I think we can make it solid. And yeah, essentially it helped me form it. And I went in here, I looked at how this differentiated to what I had typed out, and I took any ideas that it had. So like it made a really specific definition. I typed out essentially, essentially if the minimum profit threshold would be for a delta is if price hits a 1 minute swing point. So rather than if I'm in a dodgy trade, I just exit for a small scratch or something, like 90% of the time, it will at least take out a 1 minute low. And so that should be the minimum profit threshold. But I had not put a definition for it. And it's sent me the definition, the nearest M1 swing formed after entry, which is actually incorrect. I meant the obvious M1 swing low where stops would reside at prior to or after entry. But that gave me the idea that, okay, I need to actually define it very specifically. And you'll see that my definition is the first logical price point that has a realistic chance of reversing price against your entry. This includes, but is not limited to, obvious M1 swing high/low. And I can add other things beyond that by just being specific of it. So basically reading through this, seeing what it had, what I didn't, copying what I wanted and typing it in my own words. Then eventually getting that all completed. I made a few little assumptions that weren't exactly what I was after. So you'll see down here that I gave it some feedback and gave it an example of what it would look like. And then it got a better understanding of what I was aiming for. And then it helps me refine this a bit better. And we've just been going from there. But yeah, that's essentially the idea, and a very effective way to use AI. This whole concept that I'm building out here is to try and make me treat this more like a business. And I'll read out the initial idea to you. Actually, this is essentially a journal entry I did and some brainstorming I did with ChatGPT a few weeks back. But this is what I sent to ChatGPT and got a response for. But I want to provide one service extremely well and put a hefty premium on it. I can't guarantee the exact outcome for the client, but I know exactly how to deliver it, giving the optimal expediency/consistency over time. The market presents itself with a setup that has a demand for the service that I specialize in. I deliver it, execute according to my expertise and standard operating procedure. This is a premium service. The market seems not to be able to help itself. It's unclear where the market is finding the capital to spend on my service, but that is not my problem. And then that was kind of my narrative that I was building. But basically, a narrative that I'm a premium service provider and I take the orders from the market, I deliver it to spec every single time, and that is all I do. I said, I trust you get where I'm going with this. I have two frameworks in mind that have pretty good understanding on how to execute. The hard part is having the patience to wait for the actual entry, for the confirmation, and trusting that I will see it when it's there. Last week, I probably saw it and traded it 6+ times between NASDAQ and gold because my mind was clouded with all the other frameworks I was trying to execute on, and the scar tissue from engaging in bad trading habits. When the opportunity was presented, my execution only yielded me 20% or less of what was available. I've been working to develop some profit-taking standard operating procedures, which I think may just need to backtest old moves, with. to prove to myself that it is in fact effective, allowing me to deliver the premium service I provide with precision and professionalism every single time. That's the whole idea behind this page. It's just narrowing my focus on just 2 or 3 core frameworks, and I'm kind of going for 3 at the moment that I'm going to specialize in. I'm going to be extremely specific with the order spec sheet. So exactly what that is. This is just a template, but exactly what qualifies as the setup. That's very objective. And then the service delivery protocol. Exactly how do I execute on that? You can see this is also empty at the moment. So I'll build that out next. And then the invoicing protocol, which is a very important part, because if I find the perfect trade, which I do this already, like I can already find a good trade. I can already get a perfect entry. But then I do the invoicing wrong. I don't take profit at the right areas, and I manage to stop incorrectly. So that's why I've started off on this area. That was the main focus. Now we can move back over to the execution and qualification. And yeah, just slowly get more specific with it. And ideally, I'd like to be only looking for these specific frameworks that I'm after and just not trading all the other stuff. So you'll notice that even this over here, that wasn't really any of these 3 frameworks. Like, sure, that long worked, but it wasn't really the frameworks I was looking for. And like, I know there is a place for being able to trade everything. Like, there are plenty of traders who trade professionally who just take trades that are going to win. Like, well, that's they know they have edge in, and they have heaps of different trades. They're not super specific. They're just like, okay, price is going to go up here. I'm going to get long, going to get short, etc. The highest, if you want to get extremely good and have a lot of size, you have to be very, very specific with your setups. There's a video actually that I can play for you. Hopefully it's allowed. I don't know if YouTube blocks it because it comes from another video or not, but this is a video that I've had on my desktop for like a year and a half probably, or over a year and a half, from SMB Capital, Mark Bellafore. This really stood out to me and really made me think about the importance of being specific with your setup. So I'll play that for you now. I can't remember exactly what video it came from, but yeah, all this stuff in the channel is incredible. Now, I don't know if the audio is actually recording for that. Well, if the audio is not recording for it, I will paste that recording over this video while it plays.
You've got to be able to reverse engineer them so that you don't just take, because there's going to be plenty of trades with weak stocks that you try and scalp that don't work. And you're going to be scratching your head saying, well, why do they not work? There may be nothing wrong with you at all. You may be a very good trader. It's just that your strategy isn't good enough and your strategy isn't specific enough. We want you to be trading more trades like this. We want you to be trading more trades like this with more size, but you can't really do that until you're specific enough about what you're really looking for, and that you're passing on lesser trades that are not worth you scalping, and that you internalize the trades like this below 30 that you really do want to take. And when you internalize those trades, that you can trade them with even bigger size. You know, we say this a lot. We're not trying to make a couple of bucks here. We're trying to make a lot of money. We're not trying for you to just be a little trader. We want you to be a consistently profitable trader who is scalable. The more specific you're getting, the more consistently profitable you're going to be. The more consistently profitable you're going to be, the more scalable you're going to be. But we got to get you to not take all of these scalp trades that are just going to be super frustrating. They're going to wear you out. You're going to lose money. You're going to think things about yourself that are just not true. When I'm looking at this, it just doesn't have enough specific variables for that as to why that 30 level is a scalp for you. So add that to your playbook.
This has been extremely influential with how I develop my frameworks. If I jump over to some of my frameworks, you'll see that they're incredibly specific, like trade components. I have a lot of different information behind them. I have heaps of examples. I try and be very specific on them. And also back on my, if I can even find it, execution data, when I type out these very specific trades as well, like they end up being very well detailed and thought out. And that's just basically been inspired by SMB Capital and how specific they are, and how they really preach that, yeah, you want to be specific. And it makes a lot of sense. Like, if you want to scale, you need confidence in your trades. And you can only do that if you're very specific with what you're looking at and you are passing on trades that you aren't specific about. And an example of that could be my trade today. If it takes me 2 attempts to take a winning trade, that, like, I was right both times, but I got stopped out once, then got stopped out, or I didn't get stopped out, I got daily loss limits. But this is a perfectly good trade. But was I specific about it? I could make this into a specific framework. It could be like, okay, I'm looking for when we close, we break out above a key level with a really clear narrative that we've tripped in longs. We have clear pull and an inefficiency below. I buy the inefficiency. The stop goes precisely at this particular point, and then I'm looking for this, or I'm looking for a confirmation such as the last second wick or a market structure shift, and then I'm getting in at this point with a stop there. If I'm very specific, then that is scalable. If I'm not specific, which that was me this morning, I try to be specific with at least the alpha protocol. But if I'm not specific, where I'm just like, oh yeah, it looks like we tripped in these longs, there's sell side down here, I'll buy down here because I can see that we're probably going up to this 15 minutes fair value gap up here. Like, sure, that might be the case, but it's not very specific, and that results in not putting on much size. And yeah, essentially, if I want to get big, I need to be very specific. I could actually say that this is potentially my framework here. If it sells off, if this is bearish, this could be the impulse rejection failure framework, which would be interesting. And what that essentially is we've had this reversal. This is a squeeze reversal. Well, in fact, this is perfect. I'm going to trade this to the short side, and I'm going to show you exactly how to execute. We haven't got an entry signal just yet. Oh, that's the wrong place. It actually goes down here. So what I'm looking at is this is a 1900 candle open. This is a new hourly candle. What happens? Well, it did not take out the previous candle high. It instantly sold off into the range, like instantly, and dropped down fairly deep into the range. This becomes a squeeze reversal. When this happens, on any time frame where we fail to take out the previous candle and instantly reverse, it's called a squeeze reversal because I expect that it's going to squeeze out any long holders, which means that if we look for the obvious sell side pull, which is this swing low slash all these lows down here, I expect price to go down there. Now I'll show you how to execute it. Put on 100 of these. We then have a impulse rejection failure as the entry technique, and that's where we have this right here. We have the reversal, we have a pullback, putting in that low risk sell, then we break that low. So that's first stage. We then pull back and break this low. Again, this becomes the second stage. Now we're retracing above it. We want to see buy side delivery above that swing point and a closure above that swing point. And then we want to see a closure back below that swing point. As soon as we get that closure, the entry will be as close to that low as we can get. Stop loss at that failure swing high. And looks like we're about to get that. This will be a delta trade. Doesn't look like we've quite got it, not yet. So it actually needs to close below that low. This will be a delta. Why? Well, we've just hit this buy side pull. Price has clearly been bullish. The hourly time frame is still in a bullish trend. So it's going to be a delta, meaning that we're just going for a scalp. So rather than going, okay, well, I think it's going to go to this low, I'm going to be looking for the closer objectives. And if I jump over to here real quick before it happens, open up Delta, we can see that minimum first take profit as just the obvious M1 swing high/low. Then once it has hit a place it can reverse from, we want to be making sure that we're locking in those gains. We're not letting it reverse against us. To me, the obvious swing low is this one down here. That makes a lot of sense because anyone who's long from this, catching this run up, this is the first swing point we come to. Squeeze reversal indicates that we're likely to head all the way down to these lows as well, very likely. So this is prior to that, making it a high probability target. We've just hit this buy side, we're trading a bit low. It needs to get a closure below this low. I'll be jumping in short, and then I'll be looking to take majority off at this low. Because it's likely to reach down to these lows, I will try and hold a bit of a runner, but I want to give it permission to move in that direction. For the framework specific protocol, because this is a delta and not an alpha, those are less relevant. Like I want to be locking in that base hit most importantly. But with the second stage IRF framework, second stage impulse rejection failure, what we're looking for is for the second break of a low before any stop management. So what I'll do is I'll take off 50% of the trade down here, and I'll keep my stop loss in place until we have that second break of the low. So this is break one. Then we're looking for this low to get broken, a retracement, and then a second low to get broken. And at that point right there, then price should not reverse back to break even, and we should have a free trade from that point. By taking off 50% of the trade at this low, that gives me the ability to be completely risk-free while keeping my stop loss at the invalidation for this framework. And that gives me the ability to potentially reach down into this range. So that is the game plan. I'm going to move this a bit out of the way. There we go. But yeah, great example because we already caught that alpha long and I executed that pretty ideally, I'd say. And I want to see if this can play out. I just need that closure below this low. While that's happening, it's got another minute at least. I haven't done any of these in a long time actually. You'll notice how these charts look different to these charts. That just shows you how long it's been since I've been doing these. But I used to, yeah, do heaps of these and very lengthy. They took hours and hours to complete. But it was extremely helpful and I should definitely get into doing them a bit more. It's just that my focus has been in different areas more recently. So yeah, something I am noticing is how we have a bit of a trend line going on right here, which is another reason why this is a delta and not an alpha. We're in a high time frame bullishness. The hourly time frame is also bullish, and we've even got this trend line above us. So if we don't get the entry, it's likely to head higher. The impulse rejection failure is essentially because this would be the first stage, this would be second stage, and so this would be a reversal if it's a market maker buy model to head straight back up. If this fails and we get a closure back below, then there's a good chance it heads lower. But I'm going to be selling 100, risking I think a bit over $200, and then taking off 50% down here. This particular account is just my gold, specific to gold account, but you can see all these wins down here. I made 3R on this long over here, on this paper long, which is decent. Like what I've noticed with my stats is because I take profit way too early, typically my risk reward is like 1 to 1.5. Like it's really bad. And then when I combine that with taking really stupid trades, going on tilt and things, that brings my win rate down from above 50 to probably around 50. And that's why I'm the most break-even trader you've ever heard of it, like I have been in the last few weeks. It's because I'm not holding my trades past 1 or 1.5R, and then I'm diluting my win rate by taking really crappy trades. So my win rate suddenly becomes like 50%. And so I'm literally a 50-50 trader, and my equity curve was reflecting that as well. But that's why my focus has been so much on executing correctly and taking profit in the right places, which is what I've been working on here, because I recognize that this thing over here is exactly all I need to do. And if I can do this in a specific manner that gets me more than 1R, I will be incredibly profitable. Like, I can make a lot of money if I let my trades reach their expected value. Then I can do it very effectively. But we'll see if we do get this entry. If we don't, it'd be nice to see it play out and get that rep in with practicing. Got another 44 seconds. See, we have these nice 3 drives into the high as well. 1, 2, 3 drives. Aggressive breakdown. Got a long wick below us where stops will reside. So anyone who is catching this long, they'll look at that long wick and see that as a bullish rejection. And there's going to be a bunch of sell stops down below that. We initially hit that, rejected, but then failed and came straight back down. So that right there would also indicate bearishness. We're now rejecting from this short-term high. That's a very good sign. We have hit a premium of this range and closed above it. So we do want to start breaking down. That could be a nice trade into these lows. And the main thing is the squeeze reversal. And that is actually the third. I'll bring this over here real quick. So you'll see how I have these two, sell the dip and second stage RF. And we've mentioned a third framework that I'm going to be focusing on, and that is the squeeze reversal. It's a fairly recent one that I've started trading or started observing in price, but it's essentially exactly that, where we fail to take out the previous candle's high or low. It just reverses aggressively, and that happens on the 4 hour, on the 1 hour. Incredibly effective. Really like this long wick below us that we're dropping into it. Once again, traders see that as a bullish rejection that we want to get short there. If we close below this line, quite a distance below, then what I do is I measure the midpoint between the closure and the low, and I go short right there. Oh, it's not doing it. So all it needs to do is go 50% of that range right there. So now I'm short. Not sure why that's not. Oh, I'm short twice. There we go. So the reason I got short right there is because we closed beyond that midpoint. The stop loss goes at this high. I'm going to prepare my 50 to exit with. And when we close below the low, you just measure the closure up to the swing low. And that midpoint is where you go short. Stop loss goes at the failure swing high, which is all the way up here. And then we're looking for that run low. Now, I believe that we should be able to quite easily get to this low. And then beyond that, ultimately, I want to target deep discounted tenor range. And then I'll be fairly aggressive with the management at that point. So that is the trade. We'll see how that goes. See what the other time frames are doing. Really like how the 1 hour time frame has a long wick below us as well. And that combined with the fact we just broke out above the previous week high. And the previous day was a massive rally. So traders need a place to trail their stops. That long wick becomes a really obvious spot for that to happen. And we can watch 15 seconds as well, just to observe how price is moving. As I mentioned, like, I'm locked out of this account at the moment because of hitting that $400 daily loss this morning. So, and that, as well as the fact that my personal small account, I've got a few stock trades on in that account as well. And the loss I took last night on gold at 3:30 a.m. took me into enough drawdown where I'm now on full margin just in the trades I'm in. So I can't even put on a trade there. So I am restricted to demo today. Probably a good thing. It's a good opportunity to practice without any emotional attachment to the trade. I'm going to actually put a limit in here. Buy stop. No, I want to buy limit. The trading view is weird. It glitches out. It's actually the Black Friday sale at the moment. I have to do it manually. It's the Black Friday sale. I'm actually in two minds if I do it or not. I am very, very tight financially at the moment. So there's break one. And it's like, it's 217 US dollars, but then there's also another 32 US dollars tax on top of that. And it's a bit of a stretch. And the only reason I would do it is because if you think about it, it works out like $1 a day, which for the convenience you get and all the tools and stuff and being able to mark up charts, it's a nice platform to do it on. But there are a lot of issues with TradingView. Like it's really laggy, like it lags behind all the other platforms. And there's issues like not even the paper trading works properly. So I'm kind of in two minds if I do it or not, or do I try a new trading platform, which to be honest, it's not a bad idea because if I tried a new trading platform and I was actually off of TradingView for an entire year, that's a very different environment, and that's the perfect time to be changing habits, making change. Like if you change up your environment, you're going to be able to make the most changes and adapt the fastest. Like the times in my life where I've grown the most are when I've moved country or even just moved house. That's where I've seen the biggest changes, and changing my environment helps with that. Like my desk used to be over that side facing the window. I recently changed it to this side. Why? Because it's different and it gives me the opportunity to adapt in a slightly different way. Yeah, it's like it says plus $14, but we're actually up more. So there's our first TP. And now at this point, I'm still keeping it up here. So actually, no, this is a place to trail because you can see that we actually created a swing low here. So that's break one, that's break two. So at this point, I don't want price to come back to that break even. And because we are now at that, I'm now also looking to peel off because it's a delta framework and not a not the other way. So I'm very prepared to take the trade off for a full base hit, essentially. I don't want it moving against me. If it does begin to move significantly against me, I'll take more off, and I'll just leave a very small runner on for that expansion lower. But yeah, that is the standard protocol, is waiting for that first break of the low, then the second break of the low. That becomes 2, and you go to break even at that point right there. Now, I want to see this really push lower. If this begins to reverse back up towards this high, I will take off another 25. If we do get a nice push down below this, then I will also take off some another 25 as well. Ultimately reaching for this deep discount and turn range down here. Once again, delta being base hit, being that we're against the high time from draw or the trend, which in this case is both of them. So I'm taking off 25 there. Locking in that base hit, we've had a nice profitable trade, probably locked in about 1R total. And then we have that opportunity at break even to run down to our ultimate target down here. So I just put a TP down there. But that's how I'd execute a trade that is delta. So you've seen the alpha execution, which is when everything's in alignment. And then delta, we're looking for just locking in that base hit. And this is the framework. These are the two frameworks I'm looking for. So if you look over here, second stage IRF, I should have it written out here, second stage IRF, that is this entry technique where we have the clear market model framework, get that first break, that second break, and then we get that closure back below this low. That is that entry technique. Sometimes that offers you extremely tight risk. This time a little bit wider. And we're getting a nice push lower now. And because it is delta, I want to really be demanding that it goes downwards. And there we go. So how much was I risking for that? I can't remember. I think I was risking 300 or something. But if you look at that now, that was 1956. So we made $420 essentially on that trade, which is like 1.3R or so. Perfectly good trades to take. And because I was able to identify that it was one against the high time frame draw and two against the high time frame or the hourly trends, it was a low probability trade. It's also perfectly good to take, but I need to be locking in that base hit. I really liked it because we also had that squeeze reversal as a confluence, and it made it a really nice trade as well. But just being happy with locking it in, knowing that not everything is in alignment to validate that I should be holding it all the way down into these lows. And because I knew that this one here on this side was an alpha, although we'd already hit the previous week high, so it wasn't a perfect alpha because at high time from draw we'd just hit, but it still made a lot of sense. And so I trusted that, okay, in this particular scenario, I should not be taking off 50% of the trade at this first high. I should be holding up, taking a partial up here, and then holding all the way into these highs. And that enables me to make 3R on this trade. So I just made 3R and then 1.3R on this side. That's how I should be trading. Like, and I'm beginning to develop it. And if I can really develop this stuff, like I could be I've been saying it for years, like ever since I started trading, but I'm this close. Um, like I know exactly. I'm incredibly like tuned in with what I think the market's going to do, and the issues only come when I ignore it. Like in this area right here, I was going long in this area. If I go to the 1 minute chart even, and we can look at what that looks like, is we'd been selling off all day. We had perfect trend line liquidity up here with 3 50-minute highs or hourly highs. We then had a really long wick below that on the hourly time frame. So if you jump onto the 1 hour over here, you can identify that okay, we had these smooth highs, but then we also had a really long wick, or the 15 minutes, you can see it even clearer. That long wick just gave the idea that anyone who saw this trend line and thought, okay, great place to short below this trend line, we then see this bearish rejection and a big drop lower. So great place to go short from. I identified that. I saw, wow, we're probably going to go up there. I then identified that this was the previous 4-hour candle high that formed ahead of the London Open at 2 a.m. Ahead of at the London Open, we had just closed above the midpoint of this hourly wick. So on the 1 hour time frame, from this high down to the low, which is right here, that is the hourly wick. And I'll make that green because I make my wicks green. If we are bearish, you do not want to see a 15-minute candle close above that 1 hour wick. Well, it happens right there. We close above that 1 hour wick. We then have really obvious buy side after selling off all day with more obvious buy side above with a long hourly wick where traders see that as a bearish rejection and then are going to put their stops above it. And now London Open is opening just below that after we've left that there. I saw all of these signs and I was short in this area. And because I wanted to see my trade play out, I completely ignored the fact that we were more than likely going to take this high. And I held a short for like an hour, literally held a short for an hour long, and then got blasted out. The entire time I was holding this short, I knew that, okay, if I was to go long right now, I'd probably win. But you know what? I'm going to stick to my guns. I'm going to go short. I knew that, what's his name? On Top Step TV, Aaron Trades, who trades the London session. I knew that he's 100% long right now, and he's probably right. But I'm going to stay short. And I stayed short and I lost. Surprise, surprise. And tried another short, etc. But like my point being that I know exactly how to trade. I can find incredible entries. Like I was short here, 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 I was short here. I was even short here, but then I chickened out, even though it didn't invalidate my trade. Um, but then what I did wrong was I was short here, I was short here, I was short here, I was short here, I was short here. Um, Most importantly, I recognized that this was a long, but I stayed short. There are just little issues in my trading that I am doing wrong. I am messing up. I'll short the high of day and then I'll hold for 0.5 R. That kind of stuff is not very effective trading at all. It's incredibly inefficient. If I was to fix that stuff, which is what I'm working on right now, if I fix that, I will be ridiculously profitable and I know it. It's just a matter of fixing it. Don't know what on earth this is, but I need to. That's why I'm focusing on. That's why I'm making progress. I am working on it, and like I'm getting better. I'm getting better, but there's just stuff that I need to change. And we just look at that. So Delta framework, it's against the high time from draw, against that high time from trend as well. I locked it in. I was done. It reverses straight back up. And at this point, it's kind of no man's land because is it bullish? Is it bearish? It's hard to tell. We just hit this buy side pull. I believe what will tell me if we're bullish or bearish, high time frame, is if we look at this previous week high, measure that out. This goes back to that same kind of concepts. We're finding the midpoint between that wick, so that buy side pull. Oops. We're finding the midpoint between that buy side that we just hit and the next buy side pull, which is this previous day high up here. That midpoint at 72 even or so, price should either reject from there back lower, or if we get a closure back past that price, that indicates high time frame bullishness and that we're likely to reach up to this high. So if we were to, using this tool, if we were to, let's say, come up here and then close above it like that, then I'd expect, okay, we're likely to, even if we pulled back a bit first, we're likely to actually hit up to that high. That's how I would trade that. But that will do for this video, I'd say. You can see that I am working on it. I am making progress. I'm doing everything I can to get better, and I will get better. And I'm close, but I need to stop having results that represent this. Like if I'm up $800 in the day, I've been invited to my grandparents' place, my elderly grandparents, for dinner, and I'm up $800 in the day. Why the hell would I sit at home by myself, lose all my money, and take terrible trades, and then just like I felt like such a failure last night, and I still do because not only did I completely fail with this training, but at the same time I'm letting my family down, doing all this stuff wrong, and that combined with the like financial pressure and other stuff like that, like it becomes like it can take quite a toll on you. I've got to say. And this is all stuff that I can avoid. I can avoid all this stuff from happening. So I'm working on the trading. I've applied for so many jobs. I've lost count. And I'm just waiting to hear back from a few that I'm really hopeful about. I put a lot of effort into the applications. So fingers crossed get something there, but that would just taking some financial pressure off as well. That would help enormously. And it would mean that I had at least a Forex CFD account that I could throw some trades on right now to get some satisfactory trades. But it is good to be on the demo actually and to identify, oh, this is exactly my setup. Okay, I'm going to execute it exactly to spec and to do that correctly. That was a great experience right then. So that will be what today's all about, I guess. Just making sure that I'm just practicing executing everything exactly to spec. I want to fill out all of these pages and get all this locked in and just be very specific. Like this needs to, as you can see with how I wrote this, I'm a premium service provider. I'm a specialist service provider. And that means that I just execute like a professional. I don't worry about the outcome. I just trust that my protocols get my client, the market, the absolute optimal result, and the market is happily paying a hefty premium on my service. And the more specific I can get, the more specific I can get on that service, the more of a premium I can charge for it, which the market will happily pay. And that is essentially the idea, is if I can get very specific, execute exactly the same every time, allow my winners to run when the conditions are correct for that, that's going to allow me to really maximize the expected value. And also with being so specific, I'll be able to put on a lot more size, which is just a recipe for Bugatti.